Welcome back to the Wall Street Podcast.
Great to be here.
Today we're looking at a pretty significant report from Citi Research, part of Citigroup Global Markets Inc. It came out just yesterday, August 27th, 2025.
That's right. And it concerns Meituan, ticker 3690 on the Hong Kong exchange. Citi's made a notable shift here.
A shift is putting it mildly, isn't it?
Well, they've downgraded Meituan to neutral from buy, and they've cut the target price significantly down to HK $133 from HK $188. Plus, a high-risk rating.
High risk. Okay, so what's the driving force behind this change in sentiment?
The core issue really is uncertainty. Significant uncertainty about when Meituan's main engine, their core local commerce or CLC segment.
That's the food delivery and local services mostly.
Exactly. When that segment can actually return to profitability, Citi's now projecting group-level losses for the second half of this year, 2025.
Okay, so our mission for this deep dive is clear. Let's unpack these operational challenges and the strategic pivots that are prompting this revised outlook from Citi. It feels more than just a quarterly miss.
It really does. Looking at the Q2 2025 results, you can see why they didn't meet expectations.
So?
Total revenues hit RMB 91.8 billion, which is up 12% year over year, so growth is still there. But the CLC operating profit, that plunged.
How bad was the plunge?
We're talking a 75.6% drop year over year down to RMB 3.7 billion. That was substantially below what analysts were forecasting.
Oh. And the group bottom line?
Group adjusted net profit came in at just RMB 1.5 billion. Again, a significant miss compared to the consensus.
That really highlights the intense pressure even for a market leader. And the outlook for Q3. Not much better, I gather.
No, management is actually anticipating further substantial operating losses in the CLC segment for Q3.
Why the continued losses? What's the strategy?
They're investing heavily, really pushing on price competitiveness, beefing up delivery services, and running big marketing campaigns, essentially defending their turf amid fierce competition.
Right. They keep mentioning those long-term goals, 100 million daily orders, RMB1 profit per order.
Right.
But the path there seems, well, longer and rockier now.
It definitely seems longer and potentially longer than the market might tolerate. That's the risk Citi is flagging.
So what are these strategic initiatives they're pursuing? Let's look at on-demand retail or Insta-shopping.
Yeah, they're shifting focus. Less on short-term profit, more on growth. They want to really cement consumer mindshare and broaden the categories offered. It's a classic market share play.
Even now. Interesting. And what about the grocery side? Big changes there too, right?
Quite significant. They're scaling back Meituan Select, which was a big focus before. Instead, they're accelerating the expansion of Xing supermarket.
How big is that now?
Nearly 1,000 locations across 20 cities. The emphasis there seems to be on tighter supply chain control.
Makes sense. Anything else on the grocery front?
Yes, they're also exploring something called Happy Monkey. It's an omni-channel model aimed at lower-tier cities, focusing on competitive pricing for actual in-store shopping.
And the overall capital spend in grocery?
That's being significantly reduced. It signals a move towards perhaps more sustainable, higher quality growth rather than just rapid expansion.
Okay, so domestic recalibration.
Yeah.
What about internationally? Kita seems to be moving fast.
It does. Launched in May 23, Kita's already carved out leading spots in Hong Kong and Saudi Arabia and just entered Qatar.
And eyeing new markets.
They are. Brazil is currently under research. It's a huge food delivery market, top 5 globally. But management is stressing a careful, patient approach, given the strong incumbents there.
Patient but ambitious. They have a target for Kita's GMV, right? A gross merchandise volume.
Yes, RMB 100 billion run rate GMV by May 2033. So a decade-long ambition showing the scale they're aiming for internationally.
Okay, lots of moving parts strategically. Let's bring it back to the financials. How does Citi translate all this into their forecasts?
Well, the bottom line, according to Citi, is net losses for Meituan now projected for both 2025 and 2026.
So profitability pushed out quite a bit.
Pushed out to 2027 in their current model. This reflects the expectation of deeper, more prolonged losses from that core CLC segment. The market's patience, as we said, might wear thin.
Let's dig into that tension. Module 1, profitability versus market share. Management sounds confident, but how do they realistically balance defending market share so aggressively against investor tolerance for these sustained losses?
Management points to their operational efficiency. They believe their unit economics advantage is widening. But the Citi analysts, they highlight that competitors have deep pockets too. Meaning this profit drag in food delivery could last longer than Meituan or investors might hope. It's a tough spot.
Okay, Module 2, Grocery strategy evolution. Scaling back Select, boosting Jiaxiang, exploring Happy Monkey. What does this signal about their long-term priorities and how they're allocating capital now?
It really points to a refinement. Focus on controlling the supply chain via Xiaxiang, tap into lower-tier city demand with Happy Monkey's omnichannel approach, and generally be more cautious with capital, aiming for quality over just quantity.
A more mature approach, perhaps.
Possibly, yeah. Learning from past experiences in that tough grocery market.
Module 3. Global ambitions. Kita's doing well, but entering Brazil sounds daunting. What are the biggest challenges when you're going up against established giants in a market like that?
Well, Kita's success so far hinges on getting the fundamentals right. Selection, delivery, price. Brazil offers huge potential, yes, but the competition is fierce.
So the careful, patient approach.
It means really thorough research, building strong local teams, not just rushing in. It's about finding a sustainable path, even if it's not the fastest. Balancing speed and sustainability is key there.
So thinking about the impact on the general public, for you, our listener, what does all this mean?
Well, on the one hand, this intense competition Meituan is facing, it likely means continued benefits for consumers. Think competitive pricing, lots of deals, diverse services in food delivery, and maybe that Insta-shopping category.
And the shifts in their business models, like Jiaxiang and Happy Monkey.
Those could affect things locally, maybe shifts in employment, definitely changes in the retail options available in certain communities, particularly with the focus on lower-tier cities for Happy Monkey.
It certainly feels like a high-stakes game Meituan is playing, betting heavily on future dominance despite near-term pain. What does this strategic pivot, this balancing act, really tell us about the evolving economics of these huge platform businesses today?
That's the big question, isn't it? It suggests the era of easy growth might be over, and survival now demands ruthless efficiency, deep pockets, and perhaps a painful transformation towards sustainable profitability, even if it means sacrificing short-term gains. It's a tough transition we're seeing play out.